Shah Gilani.
Let's bring in Manward Press, their chief investment strategist, Shah Gilani.
Shah Gilani with me now.
Our good friend Shah Gilani is here. Shah, good morning to you.
That stock is down 58% this year, and you like it. You're buying this dip, right?
If you take the big picture, the long-term view of Intel, it's got everything in place. But this is a great buy down here. If you're not in this market, it's still not too late to get in. Before we start, I want to let everyone know I own VENU stock. I've been buying it. I'm going to continue buying it. And I thank VENU for working with me to put this conversation together. Nobody's paying me to be here today. I asked JW to sit down because I'm pretty sure the market is mispricing this company. And I'd rather put my questions to the CEO on the record than guess. JW, thanks for sitting down with me. First and foremost, for me, one of the things that stands out when you look at VENU's balance sheet is that the real estate isn't being carried at what it's actually worth today. Walk me through that, please. Why is that, and what does it mean for anyone trying to figure out what the stock's really worth?
That's exactly right, Shah. And the big disconnect under GAAP rules?
Pardon me. Yeah, meaning generally accepted accounting practices, the rule book all public companies have to follow.
Exactly. And the land contributed by our municipality partners is booked at basis.
And for anyone who hasn't heard, sorry again, the term basis just means what you originally paid for something, your cost basis.
Yes, which in our case is often effectively zero, even though our current portfolio carries a mark-to-market value in the hundreds of millions of dollars.
Apologize again, JW. You and I know, but maybe not everyone, certainly maybe perhaps shareholders don't know what mark-to-market means. Mark-to-market is the real value of something based on the real price, or what the latest price of something is.
You're right, Shah, and not everybody gets that. And that's a big part of the disconnect that I've been talking about. The same rule applies to all contributed assets, whether they come from a municipality or whether they come from a developer. The best proof of the disconnect is third-party validation, right? Our sale-leaseback transactions, where institutional buyers are confirming these mark-to-market valuations with what? Real capital plus independent appraisals. Wall Street is pricing VENU off of a traditional GAAP balance sheet that understates the real-world asset value. Restate those assets at current mark-to-market value, and the per-share intrinsic value is materially higher than where we trade today. That's the thesis. The market hasn't caught up with the math yet.
I get it. At least that's what I thought. And that's exactly why I've taken an interest in the company and the stock. So the real question is, what are these assets actually worth today? Not what's on the books. I mean, now. What does that number look like? And how far off is the stock from where you think it should be trading based on those numbers?
Let's walk through the math. At the end of March, we had about $402 million in property and equipment on a GAAP balance sheet. That's the number the market is pricing off of. But here's why that number is misleading. Here's why it's disconnected. Take Ford Amphitheater in Colorado Springs as an example. The land was sitting on our books at roughly $8 million. That's the cost basis. We just did a sale-leaseback valuing that land at nearly $50 million. Same land, same and nearly 6 times the book value.
So what you're saying is the balance sheet says $8 million, but the market just told you it's worth $50 million.
Shah, that's exactly right. And it's not just Colorado Springs. We just announced in McKinney plans for an $80 million sale-leaseback on just the parking structure. Just like the other land on our books, contributed by municipalities, it's carried at zero basis. Restating the portfolio, we estimate the mark-to-market value of our assets as of the end of this last March was over $650 million versus the $402 million on the books. Roughly $250 million disconnect. You see what I mean?
So $650 million is where we are today. Is there a way to think about where this goes as the rest of the portfolio gets built out?
Exactly right. The disconnect is even larger on an as-completed basis. We have independent appraisals on our current portfolio of over $1.24 billion on an as-completed basis, meaning once the full portfolio is built out and stabilized.
And what does that work out to on a per-share basis for investors trying to size this up?
On today's fully diluted share count, $1.24 billion works out to be over $12 a share in just asset value on an as-completed basis today. Yes, that's a forward-looking statement, and that's a forward-looking number, not today's cash value, but it shows the trajectory without even taking into account the earnings power of these assets.
This is exactly what I thought I saw and why I became so intrigued in the stock. There's no question in my mind the stock is trading at a significant discount to what those assets are actually worth. So why do you think the market hasn't reflected that yet?
First, we're a relatively young public company. Institutional research coverage,
Meaning the Wall Street analysts who follow stocks and write reports for their big institutional clients and funds.
exactly right. That coverage tends to develop over time, and it typically follows index membership. We haven't been in the indices until now, so the coverage simply just hasn't been there yet.
And without that coverage, the big institutional buyers aren't looking at you, are they?
That's part of it. Some institutional funds also have internal guidelines around which stocks they can own. Index membership, minimum market cap, analyst coverage. We're in the process of meeting those criteria, which naturally will expand the universe of investors who consider us.
So what changes that?
Yes, on June 29th, we're being added to the Russell 3000 and the Russell 2000 indexes. That's incredibly meaningful. It puts us on the radar of a much broader institutional audience, including passive index funds, that will add us as a part of their normal rebalancing process, and active small cap managers who spend their careers looking for exactly this, a hard asset business trading at a discount to what those assets are really worth.
So more eyes on the stock, more potential buyers.
More eyes, more potential buyers, and frankly, more infrastructure around the stock. Coverage, liquidity, visibility, those things develop over time, and we're just at the beginning of this process.
JW, the thing every shareholder wants to know is, how do you keep building without adding debt to the books or coming back to the equity well and potentially diluting shareholders? Walk me through how VENU actually funds its growth, please.
Not that we'll never put any debt on our books, but we have 3 tools. And this is actually one of the things that I am most proud of about how we structured this company. The first tool, the most active at this stage, is municipality financing. Local governments and economic development authorities who want a Class A amphitheater in their market bring incentives, infrastructure support, and sometimes direct financing because they understand the economic impact. We're a tide that rises all the boats. The community impact is significant.
The municipality or city is essentially a capital partner.
Exactly. Second is our fractional ownership through our triple net program. And I know you like this one.
Yes, I do. Explain that one for everyone because I think it's genius.
Accredited investors can purchase a specific piece of real estate inside our venues, typically a Lux Fire Suite, at an 11% annual return paid monthly. They own the asset, then they lease it back to us at an 11% cap rate, which is an incredible return for those investors, and then we operate it. It's twofold win. The sale of the fractional ownership is capital that we use to build our venues, and leasing the asset back gives us control of the tickets, and that is a huge P&L win. And the third is a sale-leaseback. And what's important is that we don't wait until the venue opens to execute these. That means that we're recycling capital mid-construction, not after the fact.
So you're monetizing the asset while it's still being built. Brilliant.
That's right. Now, we've used equity along the way, and I want to be straight about that. Early stage companies use equity. But the whole reason we built these 3 tools is so that equity is our last tool that we reach for, not the first.
JW, for anyone watching who hasn't been to one of these, what exactly are we talking about? And what does one of these venues generate when they're fully up and running?
So first, what we're building is not a traditional amphitheater. In fact, everybody that knows me knows that I hate the word amphitheater. Most people picture a shed that does 30 to 35 shows a summer and it sits dark the rest of the year. That is definitely not what we're building at VENU.
Not even close from what I've seen of the renderings.
What we are building is next generation venues, multi-seasonal, multi-configurational, omni-content with state-of-the-art immersive AV systems. Think elements of the Sphere experience, but accessible in your market year-round.
The technology is really what unlocks the whole model.
Exactly. The omni-content, along with the multi-seasonal and multi-configurational plan, unlocks the calendar as compared to a traditional amphitheater. You have your traditional concert programming, 30 to 40 major shows a year, the kind any amphitheater would book. But then layered on top of that is an entirely different category: theater, film, AI-generated and immersive content, corporate events, holiday programming, family shows, community events, things a traditional amp simply cannot do.
And those events fill the calendar when a traditional venue would be dark. Am I correct?
That's the key. The result is a venue targeting over 90 shows a year versus the industry standard of 30 to 35. Same real estate, same fixed asset base, roughly 3 times the utilization. A fundamentally different business model wearing the same clothes as a traditional amp.
This is exactly the kind of innovation that I think makes VENU the leader in this space. I love it. But can you put some numbers on potential attendance and potential profitability?
At our expected run rate, we project 12,500 seat venues generate about $25 million in EBITDA annually. Our larger venue, like in McKinney, is projected to do in excess of $50 million annually. Multiply that across a portfolio of 6, 8, 10 venues running simultaneously, and you can see the compounded earnings picture.
JW, these are impressive numbers for sure. Now, can you walk me through the full current picture? What's open, what's being built, and what does this look like when it's all the way built out?
Right now, we have one large amphitheater open and operating. It's the Ford Amphitheater in Colorado Springs. Pollstar nominated, Billboard top venue, operated by AEG. It has seen a tremendous amount of success in its early 3 seasons. Next up in the Tulsa market, Broken Arrow, Oklahoma, under construction now and on schedule to open in October. After that is McKinney, Texas. It's the monster, over 20,000 in capacity, and it's where we recently announced $80 million sale-leaseback of the parking asset, and that happened before it's even open. Beyond that, El Paso, the Houston market in Webster, Chattanooga, Tennessee, and additional markets in various stages of the pipeline that we will be announcing soon. We have over 45 municipalities that we are currently working with that will be coming out over the next 40 to 60 months.
JW, now let's talk about the next 12 to 24 months. What are the specific things shareholders are going to be excited about? What should they have on their calendars?
Most immediate milestone is June 29th, Russell 3000 and Russell 2000 inclusion.
Oh yes, that's a very big deal, and it's right around the corner.
Index funds rebalance into issuer names during reconstitution windows, which brings structural demand we simply haven't had access to before. After that, Broken Arrow opens in October, our second operating amphitheater and our first multi-seasonal, multi-configurational, omni-content venue.
That's an important milestone. First-time investors get to see the full next-generation model in operation. I got to say, I can't wait to see a show there.
Neither can I. Then McKinney follows in March of 2027, a larger venue projected to do in excess of $50 million in stabilized annual EBITDA. On the capital side, we continue to see strong demand in our triple net program. And on naming rights, we just announced Regent Bank in Broken Arrow, and we have active conversations going across other and multiple venues. Ford set the standard. Regent Bank is second, and there will be more.
Each one of those announcements is essentially a brand putting their name behind what you're building. That's great.
That's a good way to put it. And then on the development side, Chattanooga is newly announced, with site work and entitlements moving forward, and we will have additional markets in the pipeline soon. I also want to be transparent about something. We recently put an equity at the market offering facility in place. I want shareholders to know it's a tool available to us only if we need it, because the architecture that we have built, sale-leasebacks, triple net program, municipal financing.
That's good to hear. So the Russell inclusion and Broken Arrow are 2026, and McKinney is early 2027. Great.
That's right. By the end of this year, the picture looks meaningfully different than what it does today. 2 venues operating, multiple under construction, a growing pipeline, new naming rights deals, and a new institutional audience that didn't have access to us before.
That's a busy and exciting calendar ahead. JW, I've done my own work on VENU as an analyst and a shareholder, and I want to share with viewers what I think this company is worth based on everything we've walked through today. So let me walk through how I'm thinking about this, and I want to be clear, this is my analytical framework, my opinion, based on what's in VENU's public filings. So, as we discussed, the balance sheet on a GAAP basis shows about $402 million in property and equipment. That's what the market is pricing off of. But we just spent the last 20 minutes walking through why that number understates what these assets are actually worth. The Colorado Springs sale-leaseback closed at $49.7 million, 6 times what it was carried at on the books. McKinney has an $80 million sale-leaseback in process on the parking asset alone. These aren't my estimates. These are real transactions at real prices. When you restate the full portfolio at market value, VENU's own figures put that number at over $650 million today. That's $250 million in value sitting on the balance sheet that the market has not reflected yet. And when you look at the full build-out, independent appraisals put the as-completed portfolio at $1.24 billion. VENU has 100 million fully diluted shares outstanding. That's over $12 a share in hard asset value alone, before any earnings, before any growth, just the assets. Now let's talk about what this thing potentially can earn. Management projects $25 million in EBITDA, essentially the operating cash the business generates per venue at stabilization for a 12,500 seat venue. McKinney does potentially over $50 million. I'm going to use the conservative number of $25 million, and I'm not going to give them credit for the bigger venues. So 8 venues at $25 million is $200 million in annual EBITDA. I think that's a realistic portfolio target, and frankly, it might be a bit conservative given what's already in the pipeline. Now, I put a 15 times multiple on $200 million in EBITDA, and 15 times is not aggressive for a real asset entertainment business. MSG Entertainment it's got an 18 multiple, and Live Nation has about a 16 multiple on its EBITDA. So certainly 15, I would say, is right in the ballpark, if not a shade conservative. And what you get when I do that multiple is you get a $3 billion enterprise value on the company's earnings side. Now, enterprise value meaning what the whole business would be worth to a buyer. So here's how I see it. $12 a share. If you only value the assets, a $3 billion enterprise value on the earnings side. The stock is trading at a fraction of either number. JW, that's my math based on your public filings and my own assumptions, again, which I think are conservative on the multiple. Where am I wrong?
I'm not going to argue with your math because you're not wrong. On the asset side, our current portfolio, once completed, has been valued at $1.24 billion. And that's from independent third parties. Those aren't internal estimates. On the earnings side, we project $25 million in EBITDA per year per venue. Now it's time to execute.
Yes, I do my homework and I chase down CEOs, but don't take my word for it. I bought the stock, I own the stock, and I'm buying more. Everything we walk through traces back to VENU's public filings. Go read them, do your own work, and decide for yourself. I own a bunch of shares, and I know a lot of smart people will be buying shares, but let me play devil's advocate for a minute, because anyone watching is thinking it. Building amphitheaters is capital intensive, and you're early. JW, what are the real risks here, and why isn't the market wrong to be cautious? And I say cautious because based on where the stock price is, which I see as really undervalued, the market price reflects that caution.
The caution, Shah, comes from capital intensity and execution, right? Each venue is a large build. It's construction, permitting, and opening timelines. But you and other investors are going to see us continue hitting our major milestones, opening Broken Arrow and McKinney, advancing in Houston, El Paso, and Chattanooga. We've got more than 40 municipalities in our pipeline. So stay tuned.
JW, thank you so much for being here and answering all my tough questions. I think the stock is undervalued. I think the company is amazing. I think what you've done is amazing. Your vision is amazing. I can't wait to see shows there. And I wish you luck because, again, I'm an investor in this stock and I want to see it go where it's capable of going, which is, I think, to the moon.
Thanks a million, Shah. See you at a show.